Welcome to the deep dive. Today, we're diving into something pretty crucial. How you actually, secure the financing for those big goals.
Right. Buying a home, starting a business, a major investment.
Exactly. And often, the tricky part isn't the dream itself, but navigating the steps to get the money. Uh, People miss things.
They really do. It's easy to get caught up in the excitement, that vision of the house or the business, and then kind of sideline the groundwork for smart financing
And that's where problems pop up, isn't it? Bad terms, delays.
or missing out completely.
Yeah.
So today, we're using Mastering the Art of Secure Financing as our guide.
Our mission is basically to pull out the most vital steps from that guide, the ones people often miss, so you can get the right financing.
Yeah, not just any loan, but the best deal for you while keeping your finances healthy. We'll hit 3 core areas.
Okay, what are they?
First, really researching your options, the step everyone forgets.
Yeah.
Second, pre-qualification, understanding why that's so strategic.
Okay.
And third, getting your credit score and debt-to-income ratio in top shape. These are really the keys.
Got it. Let's start with step 1, research. The guide calls it the often missed step. Seems accurate.
Totally. You get focused on the end goal, right?
Yeah.
And you just kind of grab the first loan offer you see.
Like jumping in the first taxi without checking the fare or the route.
Exactly. But the financial world has just a huge range of products, loans, investment strategies. They're all different.
So the guide breaks down some types. Fixed rate loans, good for stability, it says. Why is that predictability so important?
Well, think about it. With a fixed rate, your main payment, the interest part, it doesn't change for the whole loan term.
Like a mortgage for 30 years, potentially.
Precisely. So if market rates shoot up, you're protected. It makes budgeting, planning for the future much, much easier. Real peace of mind.
Okay, that makes sense, locking it in. But then there are adjustable rate loans, ARMs. The guide says lower initial rates, maybe good short term. What's the catch?
The catch is adjustable. That lower rate isn't forever. After maybe, say, 5 or 7 years, it adjusts, goes up or down with the market.
So risky.
It can be. If you plan to sell or refinance before it adjusts, maybe okay. Or if you bet rates will fall.
Yeah.
But if rates rise, your payment could jump significantly.
Right. That initial low payment could become unaffordable later.
Mm.
Okay, what about government-backed loans? FHA, VA.
Ah, yes. These are designed to help specific groups. FHA loans often mean lower down payments, which is huge for, first-time buyers.
Getting over that initial hurdle.
Exactly. And VA loans give great terms to veterans and active military. It's a benefit they've earned, often no down payment at all.
So definitely options worth exploring if you qualify. Now, the guide also mentions private financing, partnerships with individuals or investors. Sounds different from a bank.
It is. Can be faster, less red tape sometimes, especially for, say, entrepreneurs with a unique plan or real estate investors doing creative deals.
More flexibility.
Potentially, yes. They might look beyond just the credit score and DTI numbers and really understand the specific venture. But, you have to be careful. Due diligence is key. Make sure they're legit.
Good point. And then there's this category of alternative financing, peer-to-peer, crowdfunding, ELOCs.
Right. Even more options. Peer-to-peer connects you directly with people lending money, sometimes at good rates. Crowdfunding, well, that's often for startups tapping into a community.
And AGLO CLOCs, home equity lines of credit.
Using your house as collateral, basically. You draw funds as needed, up to a limit. Can be useful for renovations, maybe, but risky. Your home is on the line if you can't repay.
Okay, wow. Lots of paths.
Yeah.
So how do we research effectively? Comparing rates, terms, fees, that's obvious. What else?
The guide stresses looking beyond numbers. Talk to people, get recommendations, read reviews of lenders. What's their customer service like? Are they reliable?
Like checking reviews before picking a restaurant.
Kind of, yeah. And really dig into what documents they need up front. Understand their approval process. Knowing what to expect saves so much hassle.
And the payoff for all this research.
It's not just saving a bit on interest, though that's huge. It's finding the financing that actually fits your plan, your goals, not just the first thing offered.
Choosing the right tool for the job, not just the cheapest one.
You got it.
Okay, that's step 1, covered deep research. Step 2 is pre-qualification. The guide says this isn't just a hoop to jump through, it's a strategic move. Why?
Well, first off, clarity. Pre-qualification tells you realistically how much you can likely borrow.
So you know your budget.
Exactly. And what your payments might look like. It lets you focus your house hunt or your business planning on what's actually doable. Avoids that disappointment factor.
Good point. Setting realistic expectations. What else?
Negotiation power. Big time.
Yeah.
When you walk in pre-qualified, especially in like a competitive housing market. Sellers take you seriously.
Shows you're ready to go.
Right. You're not just kicking tires. You've done the legwork. You have the preliminary nod from a lender. It makes your offer much stronger.
Okay, credibility. And the guide also says it helps avoid surprises. How so?
Because the lender does a preliminary check of your finances, income, debts, maybe a soft credit pull. If there are any potential red flags, any issues.
Like an old collection account you forgot about?
Yeah. Yeah, or maybe how your income is documented, stuff like that. It comes up early, gives you time to fix it before you're under contract and the clock is ticking.
Much better than finding out at the last minute. Okay, so how do you actually get pre-qualified? What's needed?
First, gather your documents. Proof of income is key. Pay stubs, W-2s, tax returns if you're self-employed, business financials.
Okay.
You'll also need info on your debts, credit cards, car loans, student loans. And having a sense of your credit score helps, though they'll pull that.
Get organized, basically? Then what?
Shop around. Don't just go to one lender. Talk to several banks, credit unions, online lenders. Compare their initial offers, the rates, the fees, the terms.
Just like researching loan types, you research lenders for pre-qualification, too.
Absolutely.
Yeah.
Even a small difference in the interest rate adds up massively over time. See who gives you the best preliminary deal.
Makes sense. And what if you run into trouble getting pre-qualified? Maybe credit isn't great or debt is high.
That's where those alternative options might come back in. The guide mentions exploring partnerships with private lenders or investors again.
Yeah.
They might have different criteria, be more flexible than a traditional bank.
Okay, so pre-qualification isn't necessarily the end of the road if one lender says no initially.
Not always, no. There might be other avenues.
Right. So we've researched, we've pre-qualified. Step 3 is optimizing your credit score and your debt-to-income ratio, or DTI. Lenders lean heavily on these, yeah.
Oh, absolutely.
Yeah.
Your credit score is like your financial reputation on paper. Higher score means less risk for them, usually means better rates for you.
And DTI.
Debt to income. That shows them how much of your monthly income is already going towards debt payments. They want to see you have enough breathing room to handle a new loan payment comfortably.
Okay, let's tackle the credit score first. How do we ghost it? First step, according to the guide. Check your report.
Critical first step. You need to know what's in your report. Are there errors? Mistakes happen. Things that aren't yours? Accounts reported incorrectly?
And these errors can drag down your score.
Definitely. So get your free reports. You're entitled to them from the main bureaus. Go through them carefully. Dispute anything that's wrong.
Okay, clean up the report. What's next? Paying down debt.
Yes, especially high-interest debt, like credit cards. Paying those down reduces how much interest you're throwing away, and it lowers your overall debt load, which lenders like to see.
Makes sense. The guide also says avoid taking on new debt while you're trying to get a major loan.
Yeah, that's a bad one. Applying for new credit cards or loans can cause a temporary dip in your score, plus it increases your overall debt. Lenders might see it as a sign you're stretching yourself thin financially right before taking on more debt.
So hold off on the new car loan until after the mortgage is closed.
Ideally, yes.
Yeah.
And related to that is credit utilization.
How much of your available credit you're actually using.
Exactly. The guide suggests keeping balances below 30% of your credit limits on each card. And overall, lower is even better. High utilization suggests you might be reliant on credit.
So paying down balances helps utilization and overall debt. Double win.
Right.
Okay, that's credit score. Now, lowering the debt-to-income ratio. First, we need to calculate it, right? How's it done again?
Simple formula, really. Add up all your monthly debt payments, mortgage or rent, car payments, student loans, minimum credit card payments, everything.
Okay, total monthly debt out.
Then divide that by your gross monthly income. That's your income before taxes and deductions.
Got it. Total debt payments divided by gross income. What's a good target DTI?
Lenders generally like to see it below 36%. Some loan types might allow higher, but under 36% is a safer zone. Shows you have decent wiggle room.
So if your DTI is, say, 40%, what can you do? The guide mentions increasing income. Easier said than done sometimes, but...
True, but is one side of the equation. A side hustle, asking for a raise, maybe finding a better paying job if that's feasible. Any extra gross income helps lower the ratio.
Okay, boost the income. What about the other side, lowering the monthly debt payments? Refinancing high-interest loans is mentioned.
Yeah, that can work. If you can refinance, say, a high-interest car loan or personal loan into one with a lower interest rate, your monthly payment might drop.
Even if the total amount you owe doesn't change immediately.
Right. Or sometimes extending the loan term, like refinancing a 5-year car loan into a 7-year one. Your monthly payment goes down, which lowers your DTI now. You might pay more interest long term, but it helps meet the DTI requirement for, say, a mortgage.
Ah, strategic trade-offs. Okay, those are the big three. Research, pre-qualify, optimize. The guide wraps up with some pro tips. Let's hit those quickly. Building relationships with lenders.
Yeah, don't just be an online application form. If you can, talk to loan officers, financial advisors, maybe even potential private investors through networking. Building that trust can sometimes open doors to better terms or more creative solutions.
Makes sense. People do business with people they know and trust. Another tip. Keep emergency savings intact. Don't drain it for the down payment.
Right. It seems tempting, maybe, to throw everything at the down payment to lower the loan amount. But lenders actually like to see you have reserves, cash savings.
Why is that?
It shows you can handle unexpected bumps, job loss, repairs, without immediately defaulting on the loan. It demonstrates financial stability. Wiping out your savings makes you look riskier.
Good point. Keep that safety net. And the last pro tip. Understand the loan terms fully, beyond the interest rate.
Absolutely critical. Read the fine print. What's the repayment schedule look like? Are there penalties for paying it off early? What about late fees? Is the rate truly fixed, or are there weird adjustment clauses?
Don't just sign on the dotted line.
Never. Ask questions until you are 100% clear on every single detail. It's your financial future after all.
Okay, so wrapping this all up, the core message from Mastering the Art of Secure Financing seems to be, well, preparation is everything.
Pretty much. It's about doing your homework with research, getting that realistic picture with pre-qualification, and then making sure your financial profile, your credit, and DTI looks as strong as possible.
It takes the mystery out of it somewhat, gives you more control.
Exactly. You're not just hoping for the best, you're actively positioning yourself to get approved, and importantly, to get approved on good terms, terms that actually work for you long term.
So our final thought for you listening today. Think about your own financial goals. Which of these areas, research, pre-qualification, optimizing your finances, needs your focus right now?
Yeah, maybe it's time to pull those credit reports or start comparing lender types or figure out your DTI. Understanding these foundations really empowers you.
Puts you in charge no matter what kind of financing you might need down the road. Thanks for taking this deep dive with us.